Welcome to Capital Link's company presentation series.
I am Nicholas Bornois of Capital Link, and I would like to welcome you to Capital Link's company presentation series. We have with us today the senior management of Pyxis Tankers. We have Mr. Eddie Valentis, Chairman and CEO, and Mr. Henry Williams, Chief Financial Officer. And they will take us through the company strategy and the sector outlook. A very quick mention of a disclaimer that this presentation is for informational purposes only. It is not meant to be investment advice or advice of any kind, and it is not meant to be a solicitation to transact in any securities. It's only for informational purposes. Logistics, we will start with a slide presentation, and that will be followed by a live Q&A session. You're welcome to submit your questions through the Q&A button at the bottom of your screen at any time during this session. And Mr. Valentis and Mr. Williams will respond to your questions after the slide presentation. And in closing, this presentation will remain archived for replay upon demand later on. And with this, I will turn the floor over. I'd like to thank Eddie and Henry for being with us, and I will turn the floor over to Mr. Valentis.
Thank you, Nicholas. Thank you for inviting us, and good morning to everyone. We hope we'll give you a brief presentation of the company, the sector, and of course, we will respond to any questions you might have about the market or about the company. This is the forward-looking statements, which I don't need to go through. We are a pure play product tanker company. We are currently owning 5 MR product tankers, all with eco or eco features. We have a TC average for the Q4 of 2022 of approximately 33,000. And as of January 16th, 53% of our available days are booked at an average rate of 32,500. Very disciplined and company. Substantially fixed cost structure, and we have a very competitive total daily operational cost structure as well. Very strong management team, and we have skin in the game. We have substantial, we're substantial shareholders of the company as well. The story as it for the MRs, we have a declining order book. The net supply growth for the next couple of years, approximately 2% annually. And of course, the big story for us is the improvement of the market during the last 9 months, mainly because of the Ukrainian-Russian war. The long-term fundamentals look good, and we'll go through that later in detail. Slide 4. This is the fleet, briefly 5 MRs, as I said, all 50,000 deadweight. And on column charter, you will see the current rates today. We have fixed time charters for 3 vessels, and two vessels are on the spot market. So our company focus will be the MR sector. The more specialized vessels, which can carry more cargoes. These are the so-called IMO 2 the vessels. We will grow the company opportunistically, and when we find good opportunity to do that. A very high standard of safety, solid margins, and very good levels of financial leverage and discipline within the company. We will employ a mixed chartering strategy, both vessels in the time charter and in the spot. And of course, we try to, as much as possible, to diversify our charters by customer and staggered duration. Next slide. This is briefly our ESG standards. The environmental, as I said earlier, all the fleet is eco. We comply with EEXI requirements, we have switched our vessels according to IMO 2020 regulations into low sulfur fuel. We do not have scrubbers in the fleet. We outsource our crewing and technical management to a third party, which is based in Dubai. ITM belongs to a very large management group, which is called V-Ships. Governance, we have a regular election process for our staggered board of directors, independent board members, and the various others. We comply, of course, with all applicable corporate governance, NASDAQ, and SEC requirements. Next slide, please. So quickly, I will take you through the product tanker market update, and this is, I think, the most interesting part of the presentation. Over the last 2 years, the demand for refined products has improved, mainly because the economies were coming out of the COVID-19. And of course, commercial and personal mobility was increasing. So refined product inventories also were at below 5-year averages. And of course, we had the unexpected event of the impact of the Russian-Ukrainian war, which has created substantial movement in the product tanker sector. We have seen record high U.S. gasoline prices since June 2022, and these prices have returned to January 2022 levels, but diesel and jet fuel demand prices remain still strong. So regarding the Russian-Ukrainian dispute, this has caused a rapid escalation of petroleum prices and supply disruptions worldwide. According to IEA, Russia exported 2.8 million barrels per day of refined products, of which 1.5 million to Europe. And we believe that this capacity, especially with the sanctions that are kicking in shortly, this will go out of the market and will have to be imported from other countries. So this will create an increase of ton-mile demand, which is very important for us. Next slide, please. So historically, the seaborne trade of refined products has been correlated to world GDP. During a period from 2014 to 2021, the GDP grew to 3.1% per annum, and the IMF maintained its estimate for global GDP growth in 2022 for 3.2%, but lower for 23 at 2.7%. So we expect to see demand in line with these GDP projections. In December 22, IEA revised its global oil consumption for 2023 to increase on an average of 2% per year to reach 101 million barrels per day consumption as of January 23. So as of January 23, the EIA updated its estimate for average U.S. Crude production to increase 4.6% to 12.4 million barrels per day in 2023, rising further to 12.8 million barrels per day in 2024, higher than pre-COVID levels. Next slide, please. So this is the short-term product demand growth, which facing potential challenges. So due to geopolitical and macroeconomic levels, 2 leading research firms recently estimated ton-mile growth in seaborne trade of refined products to range from 10 to 12% for 2023. Next slide, please. So after 3 difficult years of COVID, the Chinese government recently relaxed its restrictions, and this should create demand, increased demand for domestic in the domestic economy, increase in mobility for Chinese in China. Also, the government has followed its authorization to export of approximately 120 million barrels per day of transportation fuels from local Chinese refineries during late 22 and the first quarter of 23. So the export quotas, which indicate year-on-year jump rates in tons of approximately 46% of clear products and 23% of fuel oil. So this is a significant percentage of Chinese cargoes, which should be carried, the majority of which in MRs, in the medium-range tankers, especially to Asian ports. Next slide, please. So this is a slide which shows you the expected petroleum refinery capacity, the net additions driven by non-OECD growth in exports. Overall, you will see it in detail later, but overall 4.9 million barrels per day of new refining capacity is scheduled from completion from 22 to 2026, and virtually all is non-OECD according to Drewry. Very important for us because this is driving the ton-mile demand. Next slide, please. So overall, we have a positive MR2 supply outlook where the vessel order book is falling. It has dropped from approximately 25%, which was the high in 2009. It has dropped to approximately 4.9% total for the next couple of years. Very low ordering in 2022. Only 34 MRs were ordered. And overall, it looks very good. The supply outlook looks very good in the next couple of years. Next slide, please. I'll take you through the MR values just for you to get an idea of where we stand. New buildings today, approximately 44 million. The 10-year average, 36 million. So this is substantially higher than the 10-year average. Also, the second-hand 5-year-olds today, the average for a 5-year old MR is approximately $40 million, when the 10-year average was 27 million. Next slide, please. And with this, I give you Henry Williams to go through the quarterly financial highlights.
Thanks, Eddie. I think it's important for everybody to look at our most recent quarter, which we released those results back in mid-November. First of all, you can see in this slide, this is the quarter ending September 30th of 2022 versus 21. What you can see clearly right there is a dramatic improvement in revenue, let alone profitability. This was driven by fundamentally by a dramatic improvement in charter rates. As you can see, the average time charter equivalent rate down below grew almost $20,000 to $29,000 for that quarter period of time. That also was that quarterly results were affected by the fact that we had 5 MRs for the 2022 quarter versus 4 that were in the prior period of 2021. Simply, you see time charter equivalent revenues growing by a factor of 3.5 times. You see a huge improvement in profitability. Fully diluted EPS was 42 cents. Basic, you should know, was 48 cents. EBITDA was roughly $8 million for the quarter. So very, very strong. Clearly, the $29,000 down below in the quarter from the standpoint of TCE, but just putting that in a frame of reference for the most recent quarter ending in the fourth quarter of this year, the preliminary indication is that we'll be over $33,000. So again, good improvement, good momentum. Please move to the next slide. As Eddie mentioned in the beginning, we feel it's very important you understand our business and how we approach in valuing our company from the standpoint, it's more than just the revenue side, it's the cost side. And what we do is we break out here total daily operational cash costs. And as you can see in the most recent quarter ending September 30th, our total daily operational cost for eco-efficient vessels is about 8% lower than our peer group of larger public companies. And you're going to ask the question, well, how do you do that? It's really a function of, even though we're a very small company, we pay attention to every nickel within our cost structure. Next slide, please. Here's the capitalization as of September 30th, our most recent quarter. As you can see, net funded debt to total capitalization was roughly 52%. The average or weighted average interest rate for that quarter was 5.9%. We do have some interest rate protection. Roughly about a fifth of our debt has that capability. You know, the reality is it's a very balanced capital structure. Obviously, what we're doing right now is further improvement of our balance sheet from the standpoint of amortization of our debt and building further liquidity on our balance sheet. Let's move to the next slide, please. Here is the shareholder position of the company as of a couple of days ago. Roughly 10.7 million shares that are currently outstanding. Insiders control a little bit over 54% of the company in a common share ownership. There is a publicly traded convertible preferred. As you can see down below, there's roughly about $10.8 million of that currently outstanding. And there's also a publicly tradable warrant that's 1.6 million warrants that are currently out that roughly have another 2.5+ years to run. Some things that I'd like to point out here is the public float is substantially held by individual investors, most of which are in the United States. The market cap currently, as you've seen, is roughly in the neighborhood of about $60 million. The average volume is about 150,000 shares traded per day over the last 3 months. And you know, the thing that is a two-edged sword here is that based upon the most recent research report from Univest, which was published back in November, they had our net asset value for the company after the third quarter results at $9.03 per share, obviously trading in the neighborhood of $5.70. We are a significant discount to net asset value of the company. In addition, obviously, from the standpoint of earnings power, clearly, you know, right now the earnings for the company are very, very strong, and we look to continue in that effort. The price target, I should mention, there are 3 analysts that currently provide research on the company. Univest, as I mentioned, VRS, which is based in Europe, and also Think Equity. The average price target right now for our stock for those analyst reports, which were obviously of last year, was $7.57 per those reports. Next slide. This is the circle of life summary slide. And let me just say to you that at this point in time, we have a lot of the fundamental pieces for a very strong, sustainable business. Clearly, right now, the supply-demand fundamentals look very, very positive. There's very, very strong charter rates. Clearly, in the short term, there are some major catalysts, as Eddie mentioned. The upcoming EU ban on the importation of Russian refined products. Those markets, the EU markets, will have to import refined products from many, many different locations throughout the world. In addition, the Russians, to whatever level, will be shipping their cargoes longer distances. So the ton-mile play is a significant factor. And that's why a number of analysts are saying that there could be incremental growth of upwards of 12% this year. In addition, the other factor is other short-term catalyst is the situation in China. As we all know, they are dramatically relaxing their extensive restrictions that were put in place a couple of years ago that is going to trade significant rebound in economic activity within the country, but equally importantly, mobility. And Chinese New Year is currently underway right now, and so there is a greater consumption of transportation fuels, and obviously further extension from the standpoint of international transportation. Clearly, Pyxis Tankers does provide an attractive valuation from the standpoint of price to NAV, let alone based upon earnings power. With that, let's move into questions. These slides, by the way, are available on our website, so feel free to take a look at those. And let's start off. One of the questions that we see here, and I'll turn this one over to Eddie. The price cap for Russian crude by the EU and G7 countries went into effect in early December of 22. We understand that the market disruption so far has been minor, but spot charter rates for crude carriers, such as VLCCs, very large crude carriers, have fallen. Can you share with us the likely sanctions for refined products which go into effect shortly? Could rates also fall for product tankers?
Yeah, from what we understand, the market impact in crude has been minimal, as inventory restocking and trade routes had started last fall. So, I mean, in any case, the Urals have been trading below $60 per barrel, and the current Brent and the big buyers such as in China, India, and Pakistan. So in any case, price wise, it was hovering around 60. Now, we don't trade crude, but we have not heard of any major violations up to date. It's still early, but charters, owners, insurance carriers, and other interests seem to be working well together in order to contain this price cap. Regarding our sector, the price cap will come in effect in beginning of February. The prices have not yet been sorted out, but we believe that high value exports such as diesel they will have different prices. Also, low value products such as fuel oil will have different prices. So it's not clear, but there could be, as you know, there could be significant financial penalties for any violations and possible suspension of vessel insurances. So overall, the upcoming ban of Russian refined products should be similar in concept to that of crude. Regarding the rates, this remains to be seen, but as previously mentioned, inventories are quite low since they're still quite low, and for the refined products, especially jet fuel and diesel are on the low side. Let's not forget, we were all expecting a very strong winter in Europe this year, which did not happen. So as a result, we've seen some softness in the rates currently. But overall, we expect that the market will improve in the coming months. Despite the low inventories, we expect that a lot of ton-mile demand will come because imports of Europe will happen as of beginning of February onwards. So this is an important factor for us, but it's untested waters yet. We need to see how this will play out after the start of the price cap, the beginning of for refined products in the beginning of February.
Okay, let me look to the next question here. And this is another one for you, Eddie. Low sulfur bunker fuel regulations started 3 years ago, and with it, expansion of scrubber-fitted vessels. Would Pyxis consider retrofits of MRs? What is your expectation for the next stage of energy and fuel sources for maritime shipping?
Yeah, I mean, we have taken the decision of not installing scrubbers to our vessels. We have switched to low sulfur fuel as of the 1st of January 2020. Of course, we have to admit that the scrubbers have been a very profitable investment, a very good move for companies that did it, because we've seen the spread that has increased substantially when since the implementation of IMO 2020. The spread from $1,000 went up to $4,000. So the investment paid. But let me say that a scrubber investment in an MR vessel, a medium-sized vessel, is not an easy installation. It creates a lot of problems technically. So it was not an easy decision for us. And especially with at that time, it didn't make sense as an investment on our vessels. Going forward, regarding the the alternative fuel, I mean, we've currently, in our segment, we haven't seen substantial changes. I mean, currently we've seen some MRs ordered with dual fuel, and the alternative fuel was methanol. But of course, you always have questions about availability of fuel in bunkering ports, etc. So it's not an easy decision for the middle-sized sector. For as we've seen with larger vessels, many orders have been placed for dual fuel, but with LNG, and LNG, as we know, is sufficiently provided in bunkering ports worldwide. So it's still a question mark, which will be the new fuel which prevail in the middle size and smaller size vessels, and we are in a wait and see mode at this stage.
Okay, I'm going to combine a couple of questions right now to try to get to one, which is what is your particular strategic plans going forward in this uncertain environment, but specifically if asset values stay high over the next 3 to 4 years, would you go ahead and order new build vessels?
New building, as I mentioned earlier, regarding the uncertainty of the fuels, the new fuels, is not an option for us. We will not order vessels with existing technology. We will rather wait to see which is the prevalent new fuel and take our decision after that. Without doubt, the eco vessels built 2015 onwards are good proposition, supposing asset values make sense in the future. So we will concentrate on second-hand vessels, preferably eco vessels, which comply with the new environmental regulations. So we will not order new vessels, and definitely we will continue with second-hand vessels as we have done recently.
Okay, one of the sort of operational questions, looking forward 25 years from now, what harbors are the most important to Pyxis tankers?
Which areas of loading and discharging, I guess.
I think that's what's being asked, yes.
I mean, let's not forget the US Gulf for us is very important. The last 9 months, 80%, 90% of the fleet is trading out of the US Gulf. We expect to see that the US Gulf will be a major export hub for us for refined products. Let's not forget also places like Europe, like West Coast Africa, and of course the Middle East. I mean, there are significant loading areas for us, and will continue also in the future. As we mentioned earlier in the presentation, significant capacity is coming, refinery capacity is coming, and this is mainly in the Middle East. India also is a major export hub, but not for MRs. I have to say it's for the larger vessels mainly. And Singapore, of course, which is a major area for us for delivering cargoes. And the Far East, China, not yet, but we expect that China, since they are increase their export quotas, we might China might be a big destination also for us in the future.
Okay, I'm going to go back to one of the so-called operational questions, it says you mentioned that emerging market refinery projects up to 2026 being beneficial for your business model. Does it mean these routes have better profit margins or less competition presented in these routes? Hence, you have operational niche here.
No, I mean the longer a vessel is it's traveling, the less capacity is in the market. So it's very important for the vessel to be it's not available to be chartered to another party. So it takes capacity out. The longer the trading routes, the less capacity we have in the market, and this is why it is beneficial for the market. It doesn't pay any premium. It's just that the vessel is employed longer, and therefore we have less capacity available in the market for chartering, and this is driving the rates up, especially in market conditions like the one we are experiencing the last 9 months. So it is very important for the sector. In every shipping sector, the increasing ton mile is a very important aspect in order for rates to improve.
Okay. Thanks. We're going to move into some financial questions, so I'll probably be picking up the ball on that. But Eddie, if you want to chime in, that's fine. In Q3 2022, Pyxis reported adjusted EBITDA of $8 million. What was the free cash flow for that period, and what will you do with excess cash flow in the near future? Yeah, just sort of jumping into it, Q3, our interest and principal, loan principal payments aggregated $2.7 million. And obviously we had the cash dividends on the Series A convertible preferred stock that were roughly about $200,000 for the quarter. So the free cash flow was for that quarter was approximately $5 million. Obviously we're you know, for Q4, the time charter equivalent rates are higher. So, you know, it looks like Q4 will be a good quarter too. Over the near term, we expect to use free cash flow to further improve our balance sheet, continue to amortize our loans on schedule. In addition, we have a promissory note that's due on April 1st of 2024. We need to deal with that. Clearly, we're going to further enhance our balance sheet liquidity, so further strength of our financial condition. We do have, I should point out, 2 special surveys. Our 2013 built units will be going in for special surveys where we'll have off harbor about 25 days each. The total cost of those special surveys roughly aggregate $2.1 million. Those will occur in the second and third quarter of this year. Obviously, we would like to acquire tonnage, but we will do it at the right time. Clearly, that will be secondhand tonnage versus potentially doing anything in a new build way, which we have no interest in doing. So that's really the critical aspect. One of the additional questions that has come up is about our preferred stock. Our preferred stock, as you know, is traded under the symbol PXSAP. Currently trades at, I don't know, 24.50, 24.75, provides a very attractive monthly cash dividend. The question is, are we going to do anything about calling it? There is a provision in there that effective mid-October this year, we do have the ability to redeem that instrument in whole or in part. So that is a possibility. Obviously, as I mentioned, in the short term, we're going to continue to de-lever the company and enhance our liquidity. We issued that paper. We did a follow-on. We like that piece of paper, but obviously it is convertible at $5.60 per share. And so if there was an opportunity to redeem it, we would consider it. But we would only do that in context of other investment opportunities, including potentially acquiring secondhand tonnage. Let's see if there's anything else here. I think that really sort of summarizes it. Nicholas, I think let me just see if there's anything that in the last minute has come in. Yeah, one is, are you seeing any vessel purchase opportunities at decent prices at the moment? Eddie?
No, we don't. As we mentioned in the presentation, the asset values are sky high. They're at the historically high levels. So I think we have to wait until we see opportunities again.
Nicholas, I don't have any more questions. So I think we are good to go.
Well, I'd like to thank you both for a very interesting presentation. Again, I'm delighted to see that you got quite a lot of questions, and that's part of the value of this exercise, giving investors the opportunity to interact with you live. So thank you very, very much, Eddie and Henry, for being with us today. And thank you, of course, to all of our participants. And I'd like to remind everybody that this session will be archived and available for replay upon demand. So thank you very, very much.
Thank you, Nicholas. We appreciate it.
Thank you. Be well.
Likewise.